Applications looking.
Good.
That's a number I'd like to track a little bit more.
Ebbs and flows. I feel like a couple weeks ago we kind of went through a belly and then had a big flurry here in the last 7 days.
What about your contract? What about your contact to contract?
That time is continuing to grow.
That's
certainly
talk about how important that is.
So contact to contract is the time when somebody comes in, completes a mortgage loan application, we send a pre-approval, and then the time it takes them to get under contract on a property. Now, for some people, that time's very short. They may be making a very strong offer. They could be putting enough money down to where we have an appraisal waiver, and they get an offer accepted that very weekend. But for somebody who's shopping at a lower price point, let's say less than $350,000, there's a scarcer amount of inventory available to that person, and they're competing with more people in getting those contracts accepted. So that's where we see this timeline grow, especially if they have specific needs like school districts or counties or time from work as far as distance of travel. Those types of things can make it very competitive in being in the place that you want to be at lower price points.
Are you seeing contract prices kind of going up, right? I know it's hard for you to take a look at that, because you're not looking at unit to unit, but is your average loan going up?
Average loan amount is increased. Yes.
Increasing. So therefore, if your average loan is increasing, therefore sales prices are increasing.
Is average loan amount increasing because sales price is increasing, or because down payment is decreasing, or is it both?
Great question.
Is down payment decreasing because cost of living is becoming more expensive, so there's less income?
No, I think your typical buyer, depending on the situation, my advice to everyone is if you're not putting down 20% to go conventional and remove mortgage insurance,
PMI,
or potentially putting 10% down FHA, because then you're in a role that the mortgage insurance is only removable for FHA with a down payment of 10% or greater after 10 years. Now, with that said, if you're trapping additional money in a mortgage, there's no true benefit, especially right now when you are most likely going to refinance this loan inside of 12 months. Why would you go and trap money in that you could be using for other debts, lifestyle choices, whatever you've got going on, as opposed to trapping it into a mortgage that you have to pay to get that money back out if you need it?
That's